On May 11, 2026, the Nifty 50 index dropped 360 points, a 1.5% decline that effectively erased weeks of consolidation gains. This specific sell-off coincided with a shift in the underlying metrics that typically support the index, suggesting the current price action is tied to more than a temporary correction. The immediate pressure came from the Middle East. Peace negotiations between the United States and Iran have reached a sudden and publicized standstill, ending hopes for a quick resolution in the region. Former U.S. President Donald Trump rejected a counterproposal from Iran, mediated by Pakistani diplomats. By labeling the Iranian demands totally unacceptable, he effectively removed the possibility of a diplomatic ceasefire. Energy markets responded instantly. Fears of a naval blockade in the Strait of Hormuz, the transit point for 20% of the world's daily oil, pushed Brent crude futures up over 4% to settle at $105.84 per barrel. This collapse in diplomacy has forced a rapid repricing of risk assets across emerging markets, as the reality of sustained high energy costs begins to impact corporate earnings. For an economy that imports over 80% of its crude oil, $105 Brent creates immediate structural pressure. This price level inflates the national import bill, expands the current account deficit, and limits the Reserve Bank of India's ability to lower interest rates. In response, Prime Minister Narendra Modi addressed the nation with an appeal for citizens and businesses to actively conserve fuel and adopt work-from-home practices to reduce petroleum consumption. The Prime Minister also urged the public to postpone non-essential foreign travel and gold purchases for at least 1 year as a measure to preserve the country's foreign exchange reserves. These high-level advisories have caused a sharp reaction in the market. Investors in the jewelry, retail, and aviation sectors are now actively pricing in a period of lower consumer demand as the nation pivots toward energy conservation. While domestic policies are shifting, the technical pressure on the exchange is being driven by a historic liquidity exit. In the first few months of 2026, foreign institutional investors have offloaded $22 billion worth of Indian equities. This capital is moving toward the relative safety and high yields of Western markets. While the Nifty 50 bleeds, the S&P 500 and Nasdaq recently closed at record highs, driven by domestic growth and technology optimism. A strengthening U.S. dollar and rising bond yields in the UK and Germany are accelerating this trend. Global macro funds are systematically reducing their exposure to the rupee in favor of the higher nominal yields offered by U.S. Treasuries. The velocity of this $22 billion exodus is currently outstripping the absorption capacity of domestic Indian investors, resulting in the Nifty's repeated failure to sustain its previous highs. This capital flight is hitting the Nifty 50's heaviest weights first. The banking sector faces deep selling, as inflation fear suggests the RBI maintains high interest rates, which could pressure credit growth and net interest margins. Consumer discretionary stocks have also taken a hit. Titan and Indigo saw significant liquidations immediately following the government's advisories, as the market anticipates a decline in passenger load factors and luxury spending. Only a few sectors remain in the green. Pharmaceutical stocks are attracting defensive capital, while IT firms are seeing a minor benefit from the weakening rupee, which increases the value of their US dollar-denominated exports. However, because financial and industrial stocks represent the majority of foreign holdings, their decline is mathematically sufficient to pull the entire index downward, regardless of the strength in healthcare. This chart shows the Nifty 50's recent price architecture, plummeting back to its consolidation floor at 23,815. That red line marks the 200-day simple moving average, the primary long-term trend indicator. It's resting on this support. A daily close below triggers automated sell programs. The price action has shifted the market's behavior. Instead of the previous buy the dip pattern, we are seeing signs of a sell the rally environment, where institutional sellers use any upward bounce as an opportunity to exit their positions. Quantitative data from the derivatives market shows that institutional market makers are also positioning for further downside before the May 19th weekly expiry. This open interest bar chart reveals massive call wall towers at the 24,000 and 24,200 levels, acting as a mathematical ceiling. In contrast, the 23,800 support column is fragile. breaking below forces market makers to cover puts, adding severe mechanical selling pressure. With the India VIX fear gauge jumping nearly 10% to 18.55, the options change suggests we are moving into a high-stress environment, where price swings become much more erratic. Based on the current news flow and technical indicators, we can map 3 outcomes for the next session. There is a 10% chance of a sudden geopolitical de-escalation and a 25% chance of a volatile, range-bound battle between domestic and foreign investors. However, the data points to a 65% probability of a downside breakdown through that critical 200-day support level. In a market currently dominated by high energy costs and capital flight, professional strategies generally prioritize the outcome with the highest mathematical probability. To capitalize on that 65% probability, the strategy involves buying the at-the-money 23,800 put option for the May 19th expiry. This position gains value as the underlying index cascades lower. Because of the high opening volatility, a disciplined entry is required. Waiting until 9:30 a.m. allows the initial options premiums to settle, with a target entry range between 210 and 240 rupees. This graph shows the risk of time decay and volatility contraction. To protect against this Vega crush, a strict 20% stop loss on the entry premium is necessary if the market begins to move sideways instead of down. In an environment defined by $105 oil and an unprecedented $22 billion capital drain, institutional logic suggests that the most effective way to manage risk is to align with